Everybody thinks IPOs create wealth, but history says something very different. The biggest IPOs in history usually created the most excitement at the exact moment risk become invisible. And now, SpaceX may become the largest IPO the market has ever seen. A company associated with rockets, Mars, Elon Musk, and technological dominance, which means something very dangerous is happening right now. People are already emotionally invested before they have even seen the public filing. And when emotion enters the market, valuation discipline usually disappears. So in this video, we are not asking whether SpaceX is a great company. It probably is. The real question is, will the IPO make investors rich? Because history shows those are often two very different things. Today we are going deep dive into why mega IPOs are structured the way they are, the hidden mechanism most retail investors never notice, why valuation matters more than narrative, and the single metric that may determine whether the SpaceX IPO becomes legendary or disappointing. Let's begin. If SpaceX goes public, it may become the largest IPO in the modern financial history. Depending on the market conditions, some estimates suggest that the IPO valuation could move dramatically higher. Now, here is the what most investors misunderstood. The most dangerous phase of an IPO isn't years after launch. It's the first 17 days. That's the window where narrative completely overwhelms valuation. Financial media coverage explodes, social media turns euphoric, retail participation surges, and the analysts rush to justify increasingly aggressive price targets. The company becomes bigger than the stock. It becomes a cultural event. We saw this with Facebook, Uber, Rivian, Coinbase, Saudi Aramco. The pattern repeats constantly. People stop asking, what is the business worth? And start asking, what if I miss it? The psychological shift changes everything. Because once FOMO enters the market, pricing efficiency begins to break down, and IPO bankers understand this extremely very well. Most retail investors think IPO are celebrations. They are not. An IPO is fundamentally a transfer of risk. And understanding this changes the entire game. Here is how the structure actually works. The sellers, usually early investors, venture funds, insiders, and employees already own shares at much lower valuation. Investment banks then package the company, market the story, create demand, and distribute shares to the public market. And finally, retail investors become the liquidity. Now that sounds harsh, but historically, this is exactly how many IPO cycles function. Private investors absorb years of uncertainty. Public investors often absorb peak optimism. That's why understanding incentives matters more than headlines. If insiders are rushing to sell, that matters. If lockup expirations are approaching, that also matters. If valuation assumptions require perfection, that matters. Because in markets, price is not determined by the quality alone. It's determined by the expectations, and expectations around SpaceX may already be extraordinarily high. Before buying any IPO, there are three traps investors need to watch carefully. The first is lockup expiration. Typically, insiders cannot sell immediately after an IPO, but once the restriction expires, new supply enters the market. And historically, many IPOs experience major volatility during the period. The second trap is the dual class share structures. This is increasingly common in founder led companies. It allows founders to maintain voting control even when public shareholders own the economic exposure. You may own the stock without truly functioning, influencing governance. Now, with Elon Musk, the issue becomes especially important because investors' confidence in SpaceX is deeply tied to the Elon himself. And the third trap is the valuation itself. This is where IPO excitement becomes most dangerous. At extreme valuations, even phenomenal companies can produce poor stock returns. A great business purchased at the wrong price can still become a bad investment. That distinction is critical because investors often cause admiration for a company with discipline in valuation, and those are not the same thing. Now let's look at history. Some IPOs eventually become extraordinary investments, Google, Visa, Facebook. But what's fascinating is that even these winners often published investors initially. Google's IPO in 2004 looked expensive at the time. Many analysts criticized the valuation, but Google had something rare: massive long term monetization potential combined with the extremely high margins. Visa succeeded differently. It wasn't built on hype, it was built on the dominant financial network with durable cash flows. And Facebook actually struggled after its IPO. The stock fell significantly in its early public period, but over time, mobile monetization transformed the company. Now, this matters because investors looking at the SpaceX today often assume great company equals great stock. History says the assumption is incomplete, and the entry price matters enormously. Even the best companies in the world can underperform if the expectations being too high. And right now, expectations around the SpaceX may already imply near perfection. Now let's study the opposite side, the IPO, where narrative overwhelmed the fundamentals. Uber, WeWork, Saudi Aramco, each one entered public market with enormous excitement. Each one dominated headlines and each one showed how dangerous peak optimism can be. Uber's IPO arrived with a revolutionary story, but profitability remained uncertain. The stock struggled for years. WeWork became even more extreme, a private valuation disconnected completely from the economic reality. The IPO collapsed before it fully launched, and Saudi Aramco, despite being one of the largest IPOs in history, it is still demonstrated how geopolitical and valuation complexities can limit returns. Now, this does not mean SpaceX will fail, not at all. SpaceX is operationally far stronger than many of these examples, but the lesson remains the same. Narrative intensity can distort the pricing. And when everybody already believes an asset is extraordinarily, future upside becomes the mathematically harder. After studying decades of IPO history, five patterns appear repeatedly. The first day pop is not your friend. Retail investors chasing euphoric openings often become exit liquidity for institutions. Second, beware of the 6-month lock-in expiration. That's often where supply dynamics change dramatically. Third, high hype usually means the high expectations, and high expectations reduce the margin for error. Fourth, profitability matters more than excitement. Narrative attracts attention, cash flow sustains the valuation. And fifth, the most important law, the multiple is everything. If investors price SpaceX at extraordinary revenue multiples, future returns would become heavily dependent on the flawless execution, not just growth, perfection growth, and perfect growth. And that's an extremely high bar. Now let's examine the business itself, because unlike many speculative IPOs, SpaceX actually had significant operational scale. The company operates across the launch services, satellite infrastructure, defense contracts, and the Starlink. Starlink alone may become one of the most important pieces of the entire business. Why? Because recurring subscription revenue is valued very differently from launch revenue. Market typically rewards recurring infrastructure cash flows with higher multiples, and this is where the bull case becomes powerful. If investors being valuation, SpaceX is less like an aerospace company and more like a global communication platform. Valuation assumptions could expand dramatically, but there's another side to this. SpaceX still burns enormous capital. Rocket development, manufacturing, launch infrastructure, and Starship ambitions requires massive investment, which means profitability remains one of the most important unanswered questions, especially at IPO scale. This is the where a story becomes unprecedented. At projected valuation, SpaceX may enter territory modern markets have never fully tested. The company could trade at valuation multiples rarely seen outside the peak enthusiasm periods of technology cycle. And the market may justify it because investors are not really only buying revenue, they are buying optionality. Mars, satellite dominance, military infrastructure, global internet coverage, reusable rockets, AI infrastructure in orbit. In other words, investors may attempt to price an entire future economy in a single stock. That's incredibly powerful, but also extremely dangerous because the bigger the dream becomes, the harder valuation discipline becomes. One of the most interesting aspects of a future SpaceX IPO may be the retail allocation. Historically, large institutions dominate IPO access. Retail investors usually arrive later, often after the strongest pricing momentum has already occurred. But if SpaceX attempts a broader retail inclusion model, it could create something unusual, a massive public participation event that would increase visibility, liquidity, and emotional engagement also. But it may also amplify volatility because when millions of emotionally invested individuals own the same asset at the same time, price swings can become extreme in both directions. Now, here is the detail most people are glossing over. SpaceX is reportedly offering retail investors approximately 30% of the deal, and that's three times of the standard allocation of the mega cap IPO of the size. The typically institutional dominated deals gives retailers less than 10%, scraps essentially. So why the change? There are two ways to read this. The optimistic interpretation: Musk genuinely wants to democratize ownership of a generational company, a philosophical commitment to public participation. Skeptical interpretation: institutional buyers, the sophisticated money, may have hesitated at a 1.7 trillion valuation, and retail FOMO is need to fill the book. Remember Saudi Aramco? The IPO also leaned heavily on the retail and domestic participation because global institution doesn't wanted participate strong enough to justify the asking price alone. The structure of who is buying tells you something about who believes in the price is fair. At this point, people always ask one question: what about the Amazon? What about Tesla? Those looked expensive too. Fair. Let's go there. SpaceX versus Amazon in 1997. The similarities are real. Amazon was losing money, Bezos was visionary, and the market called it overpriced. But here's the critical difference. Amazon's revenue multiple at IPO was high, but not 100x. And crucially, Bezos was focused on one company, one mission, one compounding flywheel. SpaceX versus Tesla in 2010. Same founder, same ambition, same culture of engineering intensity. But the difference is one number. Tesla IPO valuation was at 1.7 billion. SpaceX is entering valuation public market at 1000 times that size. Tesla had room to grow into a large valuation. SpaceX is starting there. And SpaceX versus Saudi Aramco in 2019, record-breaking valuation, government relationships, heavy retail allocation, enormous global attention. The difference: Aramco drifted sideways for years, not because the business was bad, but because the price already assumed perfection. SpaceX shares something with all the three of these companies, and the question is why and which trajectory it follows. And the answer lives entirely in the valuation you pay on day one. The three crucial questions to answer before June 12th. So, before anyone makes a decision on June 12th, there are three questions that cut through all the noises. The first is the most important one of the almost no one is asking: who is selling and why? These are the early insiders, people who have waited over 20 years, patient, sophisticated capital that survived the early failures and near bankruptcies, the moments when these companies almost didn't exist, and they were closing to sell at this high price. This is not a small signal. The second question, that what does this price actually assume? Justifying 1.75 trillion requires Starship to reach full commercial operation, Starlink to reach 50 million or more subscribers, XAI integration to unlock new revenue streams, and zero credible competitors emerging for an entire decade, all simultaneously. That is not a bull case, that is a requirement. Any one of those assumptions falling short changes the math significantly. And the third question is the most personal one. What is your margin of safety? In investing, margin of safety is the gap between what you pay and what something is conservatively worth. It's your protection against being wrong. At 110 times trailing revenue, that margin is effectively zero. You are paying for the future that must arrive perfectly on schedule and without meaningful competition. For long-term investors, the gap matters enormously. The verdict. So here is where we land. SpaceX may be the most extraordinary company ever go to public. The technology is real. The execution has been remarkable. The market opportunity is genuinely unlike anything that has closed before it. None of that is in dispute. What is in dispute is the price, and this is the single sentence that should anchor every decision you make on June 12th. The quality of the company and the quality of the investment are not the same thing. History has proven this over and over again. Great companies purchased at the wrong price can produce years of frustration, and ordinary companies purchased at the right price can produce extraordinary wealth. Price is not the footnote, price is the entire game. So, the question on June 12th is not, is SpaceX a great company? The question is any company worth 30 years of perfect execution priced in today? This is the questions only you can answer. But now at least you have the framework to answer it honestly by your heart. If you found this breakdown valuable, there is more where this came from. The mechanism of how the markets actually work, the incentives, the structures, the patterns that repeat, that's what we build here. Because the best investors aren't the most excited ones, they are the most prepared.